What's one of those common questions entrepreneurs ask? It's how do I pay myself? If you've been following me for a while, you know that I talk about the importance of immediately separating business income from the rest of your income. So if you start a new side hustle or a new small business, or you create an entity, you're going to have a separate business bank account. And then after you start earning some money, you're thinking, how is it that I'm supposed to get this money from my business bank account into my personal life so that my family and I can eat? And that's a pretty common question. So let's talk about the two main ways that you can technically pay yourself in the right way without triggering any concerns from the IRS. If you are a small business owner and you have either a Schedule C sole proprietor business, a single member LLC that has not made a special election, or a partnership, generally speaking, these entities are going to be able to take the money right out of the business into their personal account. The reason for that is that these entities are what we call pass-through business entities. And what that means is they're like a straw. So they don't actually hold or pay any tax. At the end of the day, all the income comes in through the top, flows through the entity, and comes out to the individual who owns it at the end. So it's important to understand that you're still going to have to pay tax on it, but there's no magic that really needs to happen there. You can just simply write yourself a check. You don't need to create a paycheck because at the end of the day, whatever the profits are in your business, you are going to end up paying tax on it on your personal tax return. So sometimes people will leave it in the business so that they have working capital and they're going to, use it to get into the next thing. That's fine. But if there's profit in that business left at the end of the year when it comes for tax time, you're going to pay tax on the total profits of the business, regardless of whether you took it out or left it in the business bank account. When you take it out, you should set aside in a separate personal bank account or a personal savings account the amount of taxes that are going to be required to be paid on the level of income that you took out. What is that tax number? That part I can't answer in the general sense. If you're concerned, a good place to start is 25%. Now, if you're a partnership or a multi-member LLC and you're earning money in the ordinary way through the business, you're both considered partner owners. And if the business is earning ordinary income, you can do two things. You can still take these partner distributions, and there's different ways to do that. They can be in correlation with your ownership percentages or in correlation with a membership or a partnership agreement that's been previously directed by you guys and decided with your attorney. So you could do that. You can take a distribution, or you can take something that's called a guaranteed payment. And all a guaranteed payment is a fancy word for a guaranteed paycheck to a person who owns a partnership. Don't get scared by it. Both of them are essentially treated the same way, meaning partnership or multi-member LLCs that has not made a separate tax election are still going to have to pay Social Security, Medicare, ordinary income tax, state and local taxes. It's a lot, it is, and it can be very expensive. So understand that if you earn money out of your entity in that way, you're going to have to cover all of those taxes. So you need to be prepared for that. In all of those cases that I just said, the entity doesn't pay tax, okay? You, the individual, are the one that pays the tax. So regardless of how you take it out, realize that at the end of the day, on that final tax return that you do, your Form 1040 that you report to the government, you're going to be reporting and recording that tax to the government in that way. So to recap, if you are a sole proprietor or a single member LLC or a multi-member LLC, money can come out not in the form of a traditional paycheck, doesn't go through a W-2, comes to you as a partner or owner distribution or a guaranteed payment. And you can, as easy as writing yourself a check out of the business into your personal bank account. That is okay. Now, what happens if you have made a tax election to be taxed as an S corporation? S corporations are the big buzzword, and a lot of people talk about them. And I talk about them in both ways. They have pros, they have cons. They have places where they're good fits, and they have places where they're terrible fits. So it's important to first make sure that you've had a qualified tax professional understand and help you make the right choice for your entity. Don't just jump into the tax selection of the S Corp because somebody, me included, on the internet said this is a good choice. If you are an S corporation, then you actually now get paid in two ways. So the first way that you get paid is if you're taxed as an S corporation. Remember, you can become an S corporation for tax purposes through the mechanism of creating a traditional corporation or through the mechanism of an LLC and then choosing that tax election. So either way, both parties can get to the S corp just in different ways. If you're any of those ways and you become an S corporation for tax purposes, then you're going to get paid in that two ways. The first way is going to look like a traditional paycheck. So one of the requirements for the S corporation is that you take reasonable compensation. And in this term, when we say reasonable compensation, that means and looks like a paycheck. So just like when you had that W-2 job, this is what happens with the S Corp. You have to take a paycheck that is reasonable to the amount of work that you're doing for this entity, and you have to run it through traditional payroll means, meaning you have to subscribe to a payroll service. If you want to do it yourself, I don't recommend it. Or you have to pay somebody else to do it. There's a lot of complexities and compliance that goes into payroll. This is not one of those times for you to try to figure it out on your own because I guarantee you'll probably make a mistake and it'll end up costing you more than it's worth. So I say pay a professional service to get the payroll done, but you need to take a paycheck. You need to have it paid to you in traditional payroll form. That means that both the employer and the employee, I know you're both of them, but both parties need to pay Social Security and Medicare, and it comes out of the paycheck. You pay state and local taxes depending on where you're at, and it comes out of the paycheck. Okay, so that's the first step of how we take money out of the S corporation. Then the second way that we take money out of the S corporation is in the form of a distribution. Now, the reason that this distribution is different is that if you're an S corporation owner, the distribution that comes to you can be as simple as writing a check, but it needs to be taken in equal proportion to the amount of interest you own in the entity. What does that mean? Well, let's say I have two people who are owners or members or shareholders in an S corporation, and they're 60% owner and 40% owner. So that means that when a distribution happens from that entity, it has to be in equal proportion to their ownership. So if there's a $10,000 distribution that came out, the 40% owner gets $4,000 and the 60% owner gets $6,000, and it cannot deviate. Why does that matter? When you get into entities where you have more than one person involved and you want to start taking money out, there's a very common misconception that both parties can kind of pick and choose how much comes out of it. And in the S corporation, that is not the case. We have to stay by those rules. And so it's really important that you understand what you're doing before you start making distributions. The other thing about S corporations and distributions is that although we would commonly expect them to be just taxed as ordinary income if the money's there, we do have to have a concern. If we have an S corporation that has loans, and I'm talking like SBA loans that we maybe use to get started or fixture loans or things like that that didn't really come from us, but that are in the entity, we have to be cautious about whether or not we're taking distributions that exceed our basis. And this is way too long of a conversation to unpack in one video, but I want you to hear that. And so if you have a concern that you actually don't have enough basis or capital initially invested into that S corporation, you can't do these distributions and take that money out in the same way. Okay, so the paycheck, yes, the distributions, no. So remember, S corporations really get complex. So once you get into that, you need to be sure that you're walking alongside a qualified advisor to talk you through whether or not you can and should be taking money out. Okay, so the mechanics of taking the money out aren't that big of a deal, but how and what and how much, those questions need to be answered by a qualified professional with you involved so that you understand the tax implications of doing it right or wrong. I hope that helps unpack the hows of taking money out of your business. And if I didn't answer a question that you have and you have something else, Let me know, what else about taking a paycheck or a draw or a distribution out of your company do you have questions about, and what else can I answer?